take a look at the sectoral picture and what are the sectors doing at this point in time. If you look at the sectoral picture, actually all of them are in the negative territory, with the PSU Bank index losing the least amount, while on the flip side is the metal index, IT index, the energy index, all of them seeing sharp downtick in trade today. So that's the way how the markets are looking like at this point in time, trying to stabilize after seeing the initial dips, trying to see some sort of a recovery. But is this recovery here to stay, and what are the market readings right now? Let's bring on board our guest for today. We have Ashish Kapur as well as Kunal Bothra joining us on the show. A very good morning to you, Ashish, as well as Kunal. Thank you so much for joining us on ET Now, and hopefully we are in for a better day compared to what it was yesterday. We started, at least Tuesday was not such a great one coming in for the markets. Ashish, let me come first to you. Yes, we saw what HDFC could do, or HDFC Bank could do in particular, to the Nifty Bank as well as Nifty. We know that it has the huge weightage in both of these indices. But right now, do you think it's worth venturing in either of the sectors? Sorry, in HDFC Bank in particular, and also the banking space in particular?
Well, I think what looks like from the market texture is that banking would kind of underperform the broader market, at least in the near term. So if you're looking at something which is only investment, which is maybe 6 months to 1 year, or maybe shorter kind of a duration, or you want to trade in the market, then I think banking should be avoided, because certainly it is one of the weaker points now. I think more attention can be paid to the performing sectors like manufacturing, power, infra, even IT now. So those sectors would do better in the near term. However, having said that, I think HDFC Bank has been an underperformer for 4 years now. I think that is quite a change from what it was earlier for about 25 years. And I think, frankly speaking, the results are not as bad as the reaction in the stock. A lot of it is also because of huge FII holding in the stock, and I think this is one place which they can sell if they have to, move into cash. So a little bit of overreaction, and I think that is also giving an opportunity for long-term investors. So if you are a genuine long-term investor looking at a value pick, then HDFC Bank is a great opportunity. I think do buy in a staggered way, try and do an SIP, buy some amount now, and then buy at every regular intervals, either on a price decline or on every 15, 20 days or 1 month intervals. I think it's a great time to accumulate HDFC Bank over the next maybe 3 to 6 months with a clear long-term target. I mean, long-term would mean maybe 2-3 years at least, and then you can get a very, very nice capital creation from here, and also a very safe stock, because I think the major part of the damage is certainly done. It may just take time now for this stock to start moving up, but it's clearly for any investor who's risk averse, this is a great golden opportunity to create wealth over the long run.
All right, so that's the take coming in from Ashish, and he feels that the reaction that we are seeing in the markets is a bit of an overreaction right now, and HDFC Bank, especially at this point in time, is good, is seen to be at a good levels for a long-term investment horizon. So that's the take from Ashish. But Kunal, coming to you, we are seeing the carnage continues, but the second half of yesterday was quite scary, because the weakness just got worsened. So what are your analysis that as of now, how much confidence the kind of a recovery that we have seen is giving you at this point in time? And what's your take on HDFC Bank as well as some of the other sectors that are on your radar?
Good morning. Thank you so much for that. And I think it's good that yesterday, second half, I was not there, because I didn't see the markets in such kind of panic. But then, I would believe that net we are, we would probably have wanting this correction for the index maybe in the last 1 week or so. It's because of maybe a reason for HDFC Bank to correct that the markets have found that reason to go into a correction. I believe now that we should now be looking at a phase where the market should temper down the speed of the momentum on the upside. We could now be looking at 21,500, acting as a pivot for the index, and I strongly believe that there could be a possibility that we may maybe retest the 21,000 mark, and then on the upside 22,000 levels. These are the two ranges which I would probably believe that we should fluctuate for at least the next 3 to 4 weeks for the indices. So one should not be in a hurry to try and just buy because the indices have dipped some 400, 500 points from the 2 days high. But I believe that find a point when the index gets into a stable zone. I think there is a lot of open interest jump which is happening into the indices and shorting of fresh stocks which have happened. That could also put more pressure into individual stocks and could probably temper down the rallies for the indices. So net view is that the index would consolidate, but the range which was 300, 400 points is now broadened to almost 700 to 800 points.
So markets will consolidate, but particularly for HDFC Bank, Kunal, do you think right now chasing HDFC Bank would be like catching a falling knife, or do you think now it will stabilize?
See, I think it's always best to go with data because, as I was flagging off in the morning, yesterday there was a 25% jump in the open interest for HDFC Bank. That was clear indication of fresh shorting which had happened to the stock. And I think after today's downtick, we need to see again that whether there is closure of positions. If that happens, then we could be looking at a temporary bottom in place for HDFC Bank at this 1450, 1500 levels. If not, then there could be maybe one more round of sell-off which could probably be triggering into the stock.
Alright, so that's the take coming in when it comes to the banking space and HDFC Bank in particular. But there is another sector, while people have spoken about Nifty Bank, also they've spoken the same breath about Nifty IT index. But let's take a look at what's happening to the IT index today. And the IT index is in the negative territory, about a percent drop coming in, or 0.7% drop coming for Nifty IT. And one of the sole reasons, a major drag has to be LTIMindtree. 10% downtick for LTIMindtree, but in the same breath, let me ask my producer to pull up the chart for Oracle Financial. While LTIMindtree is down 10%, you have Oracle Financial that is reacting to its earning, and now approximately 20% uptick. And my colleague Anisha is here to decipher all of that for us and tell us why such divergent move in the large cap and in maybe a mid cap IT company. Is that the play you think people are looking at, or what's the other reason?
It's very company specific because LTIMindtree is more services business while Oracle is more product business. If you look at the services revenue of Oracle, that has actually gone down quite a bit. So services is what is weak. But you know what, let me start with LTIMindtree because that's the big talking point right now. We have seen a slew of downgrades come by, and we should pull up those two columns in terms of what the brokerages were anticipating pre-earnings and what the situation is right now. Because pre the earnings, there were 19 buys and there were 11 sell on the counter with a consensus target price of 5988. That has been brought down now. Post earnings, the number of buys have been brought down to 15. The number of sell has actually increased from 11 all the way to 16. So a lot of downgrade is what we have seen for LTIMindtree, and the consensus target price too now stands at 5,960. But what's the reason of that? The reason is that earnings were weaker than expected. Yes, there was a miss on constant currency that came in at 0.8% versus 1% expected, but it was the weak commentary that has got the stock tumbling in the trading session right now. So what was the key commentary? The commentary was that the quarter 4 is likely to be on a similar trajectory as Q3, so no recovery as such. The furloughs are expected to continue into Q4 as well, and that means there will be weakness in Q4 as well. The offshoring, utilization and client rationalization is already at peak level. So the company tried its best to squeeze out the best of the efficiencies. Still, the margin dipped this quarter. The margin actually came in at 15.4%, which was lower than our expectation. And the target that the company had of 17 to 18% EBIT margin has been pushed out a couple of quarters. So there's a delay in terms of hitting that target as well. Of course, in terms of the analyst commentary, they're not very confident about the synergies that the street was factoring into the numbers, because for now, we have neither seen the cost synergies play out, neither we have seen the revenue synergies play out. So whatever was baked into the earnings estimate is now being taken out by the analysts. So that's the story on LTIMindtree and the reason why that stock is down about 10%. But Oracle, as I was talking about, has actually reported a very strong set of numbers. And by very strong, I mean that the revenue was up a solid 26% year on year. And look at that profitability jump 70% higher on a year-on-year basis. Of course, this is seasonally a stronger quarter for products business, but even on a year-on-year basis, we have seen strong recovery there. Products business was up 29% on a year-on-year basis, even as services declined by around 2%. The company has managed to sign very strong license fee income at $49.5 million this quarter. They also signed a landmark cloud deal with the Navy Federal Credit Union of USA, and also they continue to see robust deal pipeline across the regions. and that's the reason Oracle has been doing quite well. In fact, if you pull up the last 5-day chart, you'll see that the stock is already up 30 to 40% and it's just building on to gain. So wherever there's any sign of recovery or strong earnings, it's getting a clear thumbs up from the street.
Absolutely. We in fact saw that with even Wipro and for the matter of fact Infosys as well. Any news is good news right now coming in for IT index, which was hammered out of shape at least over the last 2 years. Thank you so much, Anisha, for putting that into context, isn't it, Shrishti?
Well, yes. So very divergent moves coming in on both of these IT names. Thanks so much, Anisha, for that. But with this, viewers, let's move on and let's also hear out from the management of LTIMindtree that what's the outlook going ahead. Let's listen out from Sudhir Chaturvedi, President and Executive Board Member of LTIMindtree.
By this time, many of our clients should have firmed up their budgets, but I don't think we can see that scenario with all the clients. And wherever we have...
BFSI is our largest vertical, and it's a global vertical. I mean, it's one vertical where we have presence across the globe. What we are seeing is that the pressures on BFS spending or BFSI spending continue. So we are seeing that environment will continue for the near term. Having said that, the deal pipeline in BFS is strong. We have some new wins as well this quarter. So we will build on that for the future. But our strengths in this vertical are fundamentally strong, so we will continue to build on that. In terms of, you talked about geographies. Actually, there's the Europe, the growth or the softness in growth in Europe has also come because of BFSI, because Europe, our portfolio in Europe is heavily weighted towards BFSI. But again, having said that, some of the deals that DC spoke about in his opening remarks are also from Europe. So I think the deal momentum is strong. As we see opportunities arise and we see the environment getting better, we'll start to see a return to higher growth numbers in the future.
By this time, many of our clients should have firmed up their budgets, but I don't think we can see that scenario with all the clients. And wherever we have got the initial indication, it's only going down or at the most remaining flat. So that's the situation right now. And that's what we mean the extremely cautionary environment. Well, I think we are all hopeful that, at some point of time it has to get back to the growth, but it's very difficult to call out at this point of time with the overweighing macros and the cautionary environment.